Okay, so hello everyone. First of all, am I audible to everybody? If I am audible to everybody, you can just confirm in the chat box or in the question tab so that we can proceed forward. Hello. Okay. Okay, so all attendees, if I am audible, put it in the questions tab so that we can proceed forward. Okay. Okay, right. So, welcome everyone. I am Sandeep from EduPristine, and today I am here to take a webinar on options valuation using binomial and Black-Scholes models. Earlier in this week, in the last week actually, I took a webinar on options basics in trading strategies. This, you can say, is a continuation to that, wherein we'll discuss the valuation of options now that we have looked at the basics of options and the trading strategies. So before we start, a little introduction about ourselves. EduPristine, we are a leader in trainings for finance, and we are authorized by the CFA Institute, GARP, the FRM Institute, and the Premia. We serve a marquee client list which includes JP Morgan, Bank of America, IIM Calcutta, etc. A brief introduction about me. I am Sandeep and I am in the content development team of EduPristine. And today I am here to discuss the webinar on options valuation. So here's the session agenda. Before this, I would like to confirm if I am audible to everybody. If there are any connectivity issues, you can put it in the questions tab or in the chat box. Please confirm so that I can proceed forward. Okay. Okay. Looks like I'm audible to all the users, so I'll proceed with the session now. So the topic here is options valuation. So for people who missed my last webinar, I'm going to give a brief introduction to options once again in this to have the basics clear, and then we'll move on to the complications in valuing options. Then we'll move to the first method, which is the binomial method of valuing options, wherein we have two ways of doing it. The first is the replicating portfolio method, wherein we try to replicate the options using a portfolio. And the second is the risk neutral valuation method. We'll go through all this and we'll see the change in future stock price effect on the value. And then we'll move on to the next method, a slightly more complex while being more accurate, the Black-Scholes model. Then we'll discuss the limitations of it, and then we'll have the summary. So let's proceed forward. Options basics. Options, they give the user the right to buy or sell a particular asset. When you buy an option, you only have the right to buy, but you do not have an obligation to buy or sell an asset. Here, to buy an asset, you pay some price which is called the option premium. There are two kinds of options, a call option and a put option. Call option means you have, when you buy a call option, you have a right to buy the asset at a predetermined price and at a predetermined date of exercise. And then in case of put option, you have a right to sell the asset. And then there are two types of options, American options and the European options. European options are the ones which can be exercised only on the expiration date. Say if you buy a call option of 3-month duration, you can only exercise it at the end of 3 months. But in case of American option, you can exercise any day before 3 months in this example. So any day before expiration, it's an American option. Only on expiration, it's an European option. And then there are two kinds of positions, a long position and a short position. If you are a buyer of an option, you are having a long position, and if you are selling an option, you are having a short position. So pretty basic stuff. These are the terminology that we'll have in options. So now we'll proceed forward. So yeah, today's topic is options valuation. Before getting into it, we'll look at the complications in valuing options. Whenever we try to value an asset, valuing an asset basically means we are trying to give a price to it, to sell it in the market, and to have transactions. So any asset, the standard approach to value it is we'll try to figure out the expected cash flows from it, and then we discount them using the risk adjusted cost of capital, or which is the opportunity cost of capital. So say if your asset will give me some 100 rupees after 3 months or $100 after 3 months, so I'll discount it to today using the risk-free opportunity cost of capital that is available in the market right now, and then based on that we'll decide the value of the whatever asset or option that you are having there. But in case of options, the complications that arise are the risks cannot be exactly quantified, and so the option cash flows, we cannot be certain about them. And these risks, they are not static, they are dynamic. They change every time when the price of the underlying asset changes. For example, I buy a stock option. Whenever the stock price changes, the risk of the option changes, the cash flows change, everything change. So valuing option is that in that way pretty difficult, and is very different when compared to others. So let's now proceed to the first method, binomial method. Before that, I would like to confirm whether I am audible to everybody. If you are facing any technical issues, you can just put it in the chat box, or if it is good to go, you can confirm in the chat box. I'm going to start with the first method, but before that, just confirm if I'm audible. Okay. Okay. So yeah. Okay, let's proceed forward then. Binomial method, this is the first method of valuation that we are going to discuss today. The FRM paper, I forgot to discuss that. In FRM paper, you can expect around 4 to 5 questions from today's webinar discussion. Options valuation is one of the important topics in FRM level 1 exam. And while we go through the methods, we are also going to have examples which will replicate the questions that you are going to face in FRM level 1 exam. And for CFA aspirants, they also have some part of options which is in their syllabus too, and they can expect some questions from this topic as well. So yeah, first method, binomial method. Here, let's start with the assumptions. Here, what we assume is an asset can only take 2 values at any point of time. We'll say those values. For example, let's say the price today of an asset is S0. Here we are considering stock options. So let's say the price of the stock today is S0. After some duration, it can have only two values according to our assumption. We'll say SU as the one which is higher than S0 and SD as the value which is less than S0. So basically that's the assumption here. And then in this method what we try to do is we'll first to try to find the payoffs at these prices given, and then based on the payoffs we'll try to value the option. Valuing the option here, we can do it in two ways. First is the replicating portfolio method that I'm going to discuss now, and then the second is the risk neutral method, wherein we try to find the probability and then proceed using the discount at the risk-free rate. So in binomial method, basically here you always try to make this kind of a tree wherein you start with the stock price today, and then you will be given the U and the D values, which are the values that the stock is going to take after the fixed duration. As we said, we have only two values, we assume it, and if we have further more durations, the tree will continue this way, and if you have further more durations, it will continue this way. So pretty basic stuff. And this is the probability that we are going to discuss and that we are going to use in the second method, which is the risk neutral method. In the first method, what we do is, if we are directly given the values of SU and SD, we'll try to find the payoffs, and then based on that we'll try to find the value of option today. How do we do this? Let's proceed forward. Let's consider an example to help you understand this. Here we have a 6-month European call and a put option with identical exercise prices of ₹85. The option is at the money, which basically means the stock price today is 85 and the exercise price is also 85. The risk-free interest rate is given, which is 2% for 6 months. Here we are directly given the values, the two values that I was discussing. This will be the SD. This will be the SD, which is less than 85, and this will be SU, which is greater than 85, which is today's price. So we are asked to find the payoffs at expiration. In case of call option, we have a gain. We'll execute it when the price is higher than the today's price, which is 85. So when the price is 113.33, we'll have a gain of 113.33 minus 85, which is 28.33. And if it is less than that, we won't execute the option, so we'll have a zero payoff. In case of put option, it is the other way around. We'll have a positive payoff when the price is lesser than 85, and the payoff will be 85 minus the 63.75, which will be 21.225. And in case of 113.33, we don't execute the option, so the payoff will be 0. Okay, so let's proceed forward. So this is the first method that I was discussing. In case of replicating portfolio method, first we'll look at the call option and then we'll look at the put option. In case of replicating portfolio method, what we try to do is we try to take a portfolio which will give exactly the same payoffs as the call option itself. So here we saw that for the call option we have payoffs as 28.33 and 0. So we try to take a portfolio in such a way that these payoffs are exactly obtained for the stock prices. So suppose we buy a stock 0.5714% of stock, and we borrow rupees 35.71 from the bank. These values I'll tell you how to calculate, but let's assume for now that we know these values. Some God came and told you, let's say, and you know these values, 0.5714 of stocks and 35.71 borrowing. So the total amount that you have to pay after 6 months will be 35.71 plus the interest amount, which will come out to 36.42. So if you consider So if you consider 0.5714 shares, 0.5714 of 63.75 will be 36.42. So this is the amount that you will have after 6 months, and you have to pay this much amount. So your total payoff will be 0 after 6 months if you have stock price of 63.75, and if you have 113.33, your payoff will come out to 28.33, which are exactly the same as the call option that we discussed earlier on. So what this essentially says is we have found out a portfolio magically which gives exactly the same payoffs. So the price of this portfolio should exactly match the price of the call option. So the value of this portfolio can be found out using this 0.5714 of 85, which is the current exercise price, minus the value of the payment that you are doing, 36.42 present value, which is 36.42 is the amount which you are paying after 6 months. So the present value of that today will subtract it to get the value of call, which will come up to 12.86. So that way we formed a portfolio, we got exactly the same payoffs, and thus we found out the value of call. But the questions to answer is, how did we get these magical figures of 0.5714 and 36.42 or 43? The answers are here. This 0.5714 is called the option delta, and it is found out using this formula that I listed here. The option delta is given by spread in the option prices by the spread in the share prices. So the option prices, we got them as 28.33 and 0. Earlier we derived these, and the stock prices we derived them as 113.33 and 63.75. So based on this we get this 0.5714, and this is the amount of underlying stock that you have to buy to replicate the portfolio, and the amount that you have to borrow, that we get from this, which is equal to the difference between the payoffs from the option and the payoffs from the delta shares. So in the case of 63.75, the payoff from the option is 0, while the payoff from the delta shares is 36.43. So the difference is 36.43 minus 0, which will give you 36.43. And in the other case, the value of the delta stock is 64.76, and the payoff from option is 28.33, which will again give you 36.43. So thus the present value, the amount that needs to be borrowed will be the present value of this 36.43, because obviously after 6 months you will pay some interest on the amount that you borrow. So the present value of that using the risk-free rate given in the question will give you the amount that you have to borrow. So this is one method by which you can find out the value of option, based on which we found out the value as 12.86. Okay, right. So let's move on to replicating put option. In case of replicating put option, it's the same, except that here instead of borrowing, we are going to invest the money in a risk-free investment, and instead of buying delta share of the stock, we are going to short sell delta share stock. So it's exactly the opposite. Instead of buying and then borrowing, instead of borrowing and buying, we are going to sell and then lend the money in a risk-free investment thing, which will give you risk-free returns after 6 months. So the delta will be again here the same case, spread of option price by spread of share prices, which will give you minus 0.4286 here. And here the amount to be placed in risk-free investment will be the sum of the option value and the value of the delta stock. There it is a difference. Here it will be the sum, which will give you 27.32 plus 21.25, which will be the 48.57. So here the put can be replicated using the portfolio of 0.4284 shares, which is the delta that we calculated. Based on which we get these values, and then we try to repay the lower interest, which is 48.57. So the ultimate payoff will be 21.25 in one case and 0 in other case, which is exactly the same that we determined earlier on. So based on this, we can use the we can similarly find the value of put option and the present value. So we subtract the shares value and we add the present value of the loan that we are giving. Earlier what we did is we bought the shares. So here we are selling the shares, so the sign is exactly the opposite. Here we are lending instead of borrowing, so the sign is again the opposite. We get rupees 11.19, which is the value of put option. So at this point, I'd like to confirm if I'm audible, and if there are any questions, I'm ready to answer. So you can put up your questions in the questions tab or in the chat box if you have any questions. And if I'm audible, you can confirm so that we can proceed forward. So I'm waiting for your responses. If you don't have any questions, you can just say proceed forward. So I can proceed forward to the next topic, which is the next method. Okay. Okay. So right. The responses pretty much say that I can proceed forward. So now I'll move on to the second method, which is the risk neutral method. In this case, we have certain assumptions. The assumptions are that investors are indifferent to risk. They are not really caring about risk. So here the steps that we follow are, first we determine the probabilities associated with the different payoffs, and then we determine the expected cash flow. assuming that the investors are ready, not are risk averse, I mean risk neutral. They don't care about the risk, and here we'll again discuss the same example. We are again going to discuss the same example here. We had the risk-free rate as 2%. So in this case, what we do is we try to find the risk-free probability based on which we can proceed forward. So here, the expected return is the risk-free rate, which is 2%, which can be calculated by the probability of raise and the probability of fall multiplied by their respective upward trends and the downward trends. So suppose we are given that we expect a 33.33% increase in the stock and 25% fall in the stock. Then we can find the probability using this equation, which is probability of rise into 33.33% plus probability of fall, which will be obtained using 1 minus probability of rise, and this will be 2%. Based on which, if we calculate, you can simply get the probability of rise to be 46.3%. Once we get this probability, the value of the call option after 6 months can be easily calculated using this a simple formula, which will be probability of raise into the payoff for the raise and probability of fall into the payoff of fall. In case of call option, when the price falls, you have zero payoff. So basically it becomes 0.463, which is the probability into the payoff when you have a raise in price. So again we have the same value, 13.16. Once it is discounted, we'll again get the same value, which is 12.86, which is same as what we have obtained using replicating portfolio method. Similarly, we can do for put option, and the method is pretty much the same. So now we'll have a look at the change in future stock price, how it affects it. Here, as I said, the U and D values can be calculated if they are given in question, well and good, or in case they are not given, there is a standard formula to calculate them. U can be calculated by using e power sigma root t root h, where t is the time duration, sigma is the standard deviation of the continuously compounded stock returns. In questions, you are either actually given the U and D values directly, or you will be given the time duration and the sigma value. So either way, you can calculate the U and D values, and from which, once you get the U and D values, for example in this case you have U equal to 1.33 and D equal to 0.75. Once you get them, you can easily find out the future stock price by just multiplying the current stock price using the values U and D respectively. So let's proceed to generalize the binomial method. Till now we have discussed only one step binomial method, wherein we assume after some time duration we have only two values that the stock can take. To make it more realistic, we can include more time durations. For example, if you buy a 6-month call stock option, you can as well make it a two-step binomial method by using a 3-month steps, 3-month 2 steps you can use, and then you can proceed in a similar way as we proceeded in the 1-step binomial method. So that's pretty much it. Here again you can find the U and D values as given, and the U and D values change according to the time duration you take. The shorter the time durations, the values will reduce obviously, and you get lot more branches in your tree, and the value that you find for the call option will be a lot closer to the actual value, and it will be more accurate. So that's what is written here. If the time duration, it can be made extremely small, we can take into account a large number of changes in the share price, and thus our stock option value that you calculate will be a lot closer to the real value market. Today we have computer programs which use multi-step binomial method to calculate the value of options very precisely. So here's an example. This is from one of the FRM previous papers. Here we have it's a classic question on two-step binomial method. Here we have stock price today, which is 100, and the probability is 0.3 upside probability, and 0.7 is the downside probability. For the price to increase or decrease by so this will be 110 and this 90 here. Again we have 0.3 and 0.7. It will be 120 here, 100 here, again 100 here, and 80 here. So basically we have final payoffs as 120 with a probability of 0.3 to 0.6 will be 9%, 100 of 0.2 plus 0.7 and 0.3, which will be 42, which is 42%, and we have a probability of which will be 0.4 or 49%. So the mean can be simply calculated using this 9% into 120 into this, 40% into this, 49% into this, which will be 9, and the standard is x bar whole square, no, x minus whole square into p sigma we can have. So that's pretty much it. Standard deviation and mean 92 and 12.96. The calculations are simple here. You can go through them. I'll send you the PPT after the webinar. You can go through these questions. You can go through the PPT again. So for now, I'm moving on to the next method, which is the Black-Scholes method. But before that, we'll have a short question session. If you have any doubts, you can put it in the questions tab or in the chat box. And if you have any technical issues, you can put them there too. Before moving on to the Black-Scholes model, I would like to confirm if you have any questions or if you have any technical difficulties, you can put it in the chat box. Okay. So Anil has a question. He asks me to explain this binomial method once again. This question, I'll definitely discuss it. Here we are given the current stock price as 100, and we have two steps basically. The stock will either increase by $10 or decrease by $10, and the probabilities are given as 0.3 and 0.7. So they have asked the mean and standard deviation after 2 months. Mean, it's simply using these two steps, we can simply calculate that as I showed you here. And the variance can be calculated using the formula for variance, which is sigma p into x minus x bar whole square. X bar we obtained mean as 92. So x, the values are 120, 100 and 80. So we'll sum them up to get the variance as 168, which will give you a standard deviation of around 13. Okay, let's move to the next method, which is slightly more complex while also being slightly more accurate. Black-Scholes model. Here we can have infinitesimally small intervals. It's basically an enhanced version of binomial method, which with time durations as small as like infinitesimally small intervals. So here the formula is again we saw in the replicating portfolio method. We'll try to have delta into share price minus the bank loan or the lending. If it is for the put option, the signs will be different. So here we try to replicate that, and we'll try to bring in the probability density function to account for the infinitesimally small intervals. So the formula here is ND1 into stock price, where ND1 is the cumulative probability distribution function, and ND2 is again the cumulative probability distribution function, which will represent the probability of distress, and present value of exercise price is multiplied to it. So this is the formula where D1 and D2 are as shown the values. You can use the formula directly to calculate the call option and put option values. So here's an example. The price today is given, the exercise price is given, sigma is given, time duration is given. I took the same example again. You can find the D1 and D2 values by just substituting in the formula that I showed here. And then you can find ND1 and ND2 using the probability tables that will be given to you in the exam, or you can simply type in norms distribution D1 in Excel to get the value, which are 0.58 and 0.47 here, and the present value of the exercise price is found out, and finally the value of call is simply this ND1 into P minus ND2 into present value of exercise price, which will come out to 10.49. Here we can also include dividends in case of stocks. Basically, in case of dividend paying stocks, the price of the stock should be adjusted for dividend, and the remaining classes calculations are pretty much similar. So here without dividend is the one that I have calculated earlier. With dividend you have to adjust for the dividends. If you pay a $2 dividend, the price should be adjusted accordingly, and the calculations further will take into account for that, and the value of call option as expected has decreased and has come out to be 9.36. The limitations of Black-Scholes model. Limitations, what it basically has is it does allow for early exercise. So American options, it's not suitable for that. Binomial method is superior when it comes to American options, particularly American puts and American calls that pay dividends. So in case of dividends, it becomes slightly more complex, and in case of Black-Scholes, it doesn't actually allow for early exercise. It only allows for exercise on the expiration. So also in case of valuing warrants, binomial method is suitable, but it is quite difficult to value warrants because their value is quite likely to change during the duration, and they can have dividends paid during their life, which also adds to another level of complication. And of course they can be converted into shares, and hence the total number of shares increase, which again complicates the model. And ultimately what this basically says is, in case of American options and in case of warrants, Black-Scholes is slightly limited when compared to binomial method, but it's a lot more accurate when compared to binomial method for other methods. So here's a summary of what we have discussed. We have started with the binomial method. We have looked at two ways of doing it. One is the replicated portfolio method and the other is the risk neutral method. In case of replicating portfolio, we calculate the option delta using this formula. And then in case of replicating a call option, we form a portfolio by buying delta share of stocks and borrowing a sum of money for that. While in case of put option, it's the opposite. We sell delta share of stocks, and the money that we get, we deposit the money in a risk-free investment. So in risk neutral method, we try to come up with the probability which is found out using the expected return, the risk-free rate. Once we have the probability and the UND values, we can again proceed to find the value of the option. Finally, we had the Black-Scholes model, in which we have this simple formula, ND1 into P minus ND2 into P wave of exercise, wherein the values of D1 and D2 are as given. You can simply calculate using this. In case of put option, the sign slightly change, and minus D2 will have the opposite basically. So that's it. That's the session here. And we have a lot more other webinars that we had early on. We had a webinar series that we have started for the benefit of FRM and CFA preparation of yours. The exam coming up in May and June. For that, we had sessions on linear regression, understanding income statement, hedging strategies, and many other webinars we had launched during last 3 weeks. Here are the links for the blogs, and you can find other blogs on our website at pristine.com/blog. And there are, of course, upcoming webinars on the topics of your choice. You can simply drop an email, or you can comment on the blogs for a topic that you want us to discuss, and we'll have a webinar on that as per your choice. And you can check the webinars updates on our site edupristine.com/webinars for more details in future. And now we are going international. We have a classroom training coming up in New York, Boston, and Chicago in United States, and in London in United Kingdom. We'll have a 4-day review course for FRM before the FRM examination in the first week of May in all these centers. To enroll for that, you can contact us by emailing to zainab@edupristine.com or zainab@edupristine.com, you can have any queries, you can drop a mail to this, or you can visit the site of ours, edupristine.com/courses/FRM program. And if it is for the CFA aspirants, you have the CFA program too, which will be later in May, in say third week of May tentatively. So those are the things that we have coming up. So yeah, that's it from me. Thank you for your patience. If you have any questions, you can put it in the questions tab, and any queries regarding the FRM exam, regarding the questions, anything you can ask me. Or if you do not have any questions, so that's it from me. So I'll wait a minute for you so that you can put your questions in the questions tab or in the chat box. Okay, so Marquez has a question. He asked me what's the pattern of FRM examination. For part 1 exam, you have 100 questions to answer, and in part 2 you have 80 questions to answer. The level of questions is slightly higher when compared to CFA examination, and today based on options valuation, you can expect around 4 to 5 questions in the exam. So yeah, that's it. That's the significance of today's session. Hope it has helped you all. So that's it from my end. Signing off. Thank you. So yeah, that's it. Okay.